Hi, I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. Continuing our coronavirus roundtable series, today I'm joined by Tariq Dennison, the author of Long Run Income, which is a service that offers robust income investing ideas that have been tested through time. So, Tariq, how are you doing?
Doing great, Daniel. How are you?
I'm well. Thank you for joining me today. So, we did a recent roundtable on dividend investing and also your focus globally. So, I wanted to kind of hit both of those themes. I want to start with just, everything we're doing right now, we're trying to size what's going on and which companies to invest in given the uncertainty in the market. You had mentioned you were looking for sustainability in your companies and for medium term upside in terms of free cash flow. I'm curious how you define those. What do you mean what do you look for to prove sustainability from the business level, and what do you mean medium term? What is that looking like, and how do you deal with the fact that we arguably don't know what's going to happen for quite some time in the markets given all the COVID-19 stuff that's going on?
Certainly. I'll try to address this one at a time as I can. So, first of all, sustainability. As we were speaking earlier, that is a loaded word, and it can have either ESG connotations or it can be purely from an investor's point of view. I want to make sure the money that's coming out of my investments keeps coming and doesn't dry up because it's in a business that is not sustainable in the sense that uh, a catastrophe, a virus outbreak, changes in consumer habits would suddenly make that business unsustainable. So really what I look at there is I start with the bottom line. I start with either the dividend or dividend alternative, as I call it. So we don't just buy dividend paying companies. We'll buy companies that buy back shares, that pay down debt, that will accumulate to the bottom line in some way. And then we work our way up and see, okay, where ultimately did that come from? So ultimately, it has to come from some sort of sales and revenue, and we have to say, well, are those sales and revenues sustainable? One of the reasons that I've been so busy looking at the oil sector is that oil is often thought of, oh, that's a business that's not, maybe not sustainable. But we were looking earlier this year, many really high quality oil companies are priced as though the world is going to stop using oil by 2028. So within the next 8 years. So just do quick math on the spreadsheet, do a simple DCF analysis, and show declining cash flows and say, okay, even if they decline, and then after 2028 we use no more oil, I will still make my money back on some investments in that sector. If you don't believe that's going to happen, those are still relatively good investments, just purely on a money in versus money out perspective. Now, that may not be what you call sustainable in the sense of, let me put that in my infant daughter's account and tell her not to look at it until age 60. Those are the types of investments where we're going to look a lot more for sustainability. We want to look at what are the industries that really aren't going to change for the next 50 to 100 years, because we're talking about consumer products, we're talking about land ownership, we're talking about food, the types of things which again really aren't going to change. Now, when we talk about time horizon, you see when I was talking about 50 to 100-year time horizons, that's my idea of long term. And I was saying medium term, where to me, medium term is really, I would say 5 to 10 years, but really anything greater than 2 years, because 2 years, the next 2 years to me is the ultra short term. That's the period within which you really should be focused on fixed income. You should be able to really draw out your calendar to all your cash flows that you should expect and not have any uncertainty about it. What that means is that you shouldn't have to sell anything in the next you should never buy something with the intent that you have to sell it in the next 2 years. You buy a bond that you expect matures. You buy a stock and you expect the dividend is going to be within a certain range. But you shouldn't have to expect to sell anything within the next 2 years, preferably not even the next 7 to 10 years. So it's that 2 to 7 to 10 year time frame. That's what I consider medium term.
Okay, so on the other side of the ultra short term, you'd mentioned also you had some distressed companies you were interested in, and that to me, I would guess you do need to really think about, are they going to be able to make it through the next 2 years? Are they going to need to sell things to stay afloat or whatever else? So again, how do you think about when you go into sort of the murkier waters? How are you? What factors are you thinking about right now over the next 2 years?
Well, so distressed can mean many, many different things, I guess, just like sustainability. And so for now, let's talk about what truly distressed means as in a very real possibility of going bust in the next year. A very real possibility that the debts that we see coming due in the next year are not going to be paid. They will not have cash flows purely to cover them. And I can come up with several examples. One you could think of are the cruise lines. So cruise lines ordinarily have pretty decent businesses. They've got regular bookings coming through. They've got cash flows from those bookings. Many of them have valuable assets, ships, for example, which are worth many billions of dollars. And so Carnival was slightly less levered than the other two major ones. Royal Caribbean and Norwegian had slightly more debt relative to the value of their assets, but overall, they weren't the most highly leveraged businesses, at least not when you compare it to financials or certain REITs. Now, when you talk about suddenly having a year when nobody books a cruise at all, so let's say zero revenue, we have to do a model where we say, okay, well, what will that mean for the overall cash flow situation? And let's take a name like Carnival that actually has a bond due in October. Mm-hmm. So there we actually have to make some very, very real assumptions. So let's assume zero revenue for a year. Those cash flows aren't there to pay down that debt. And they will either have to refinance, sell some ships, do something in order to pay a debt. And that's a classic liquidity problem. From Carnival's point of view, they don't really have a solvency problem. It's just that they have big illiquid assets, and they have short-term liabilities that in normal circumstances we would expect to roll. And you would find very, very similar things in many, many, many REITs. Much of my review of the REIT sector and MLP sector was really just looking at what are the cash flows, how long will an interruption of those cash flows last, and what really is the default scenario that we're talking about. You've got to make a trade-off there between going deep and going broad. And with what I do, because I'm not a sector specialist in either of those areas, I had to really just go broad across over 100 REITs, across a dozen MLPs, across all three cruise lines, and just do simple good scenario, bad scenario models, and come up with almost an actuarial probability of how many of them I would expect to go bust. And then really the buy-sell decision is, do I expect a larger percentage are going to go bust or a lower percentage are going to go bust?
So when we're talking about, to take the cruise lines, for example, Norwegian was just in the news yesterday. I think they raised capital. Carnival has raised capital at a expensive rate, but they raised capital. I haven't actually seen it for Royal Caribbean, but I would imagine they're in a similar boat, to use the term. How much do you factor? You said broad versus steep. Are you factoring in those sorts of things, like scenarios where they can raise capital, push out maturities, that sort of thing? Is that part of the process?
Well, yeah, really proper modeling of any business, of any stock, really is using a cash flow calendar. So we're really looking at, okay, sales this month, sales next month. Usually we don't get down to the month level, but really with a spreadsheet, we can make it as fine or as granular as we want. And then on that calendar, we of course have the liabilities, the things that need to be paid out as well. And the nice thing about debt is that they've got maturity dates. We see when all the interest payments are coming due. We see when all the principal payments are coming due, and we can lay them out. And so we can simply go and simulate. We say, well, if cash flows are lower than expected for this period, this debt will not be paid in full on time. They will need to either refinance or sell an asset. Now, the nice thing is we've started seeing this play out. We've been seeing refinancing. We've been seeing some of this come through. And we've also been seeing, well, okay, the Fed is coming through with facilities to fund corporate bonds. And we've been seeing a lot of the dislocations in the bond ETF markets getting somewhat corrected by the Fed willing to step in and buy corporate bond ETFs, for example. That, in theory, should make it easier for these companies to refinance. I mean, one of the comments I got in my article on Carnival is, what banker in their right mind would want to lend money to a firm in this situation? And you always have to say, well, whenever you're lending money, there's asset-based lending and there's cash flow-based lending. And ultimately, the two need to be the same thing. Why on earth would you be willing to take a ship as collateral unless you feel that there are cash flows that you can get off of it, and vice versa? If nobody is buying ships because no one has any use for ships, because nobody is using ships, they're not going to have the cash flows, and those ships aren't going to be very valuable. So I know I've said that in a lot of words, but that's something that is pretty easy to put on spreadsheets. You ultimately are putting columns of months, quarters, or years, and then cash flows in versus cash flow out.
Yeah, it's funny when you see the different valuations, and you kind of forget that the asset values mean something in there, that the balance sheet is connected to the cash flow statement and the income statement, and that they're all in theory at least, supposed to be moving in sync.
Well, and that's why I think when every time you see a number, you have to think of what does that number really mean. And when you look at a balance sheet, that balance sheet is reported at book value. Now, the price you see in the market is in theory supposed to be a market value. The market is in theory putting all that information together and saying, well, the real market value of the ships minus what we really expect, they're going to be able to pay on their debt and so forth like that. That's our real expected, net option value or net asset value of the price per share. And same thing with the bondholders as well. If you saw how the Carnival bonds were trading, you saw how they were going from, really investment grade, to suddenly trading at pretty distressed levels. We were looking at the Royal Caribbean bonds lately, trading at 20+% yields, which again, simple back of the envelope math indicates a very high probability of default. And in the event of default, what sort of recovery rate you've got there? That's the bond market giving you some clue on what they think those ships are worth. Again, from a cash flow point of view, because bond investors and bankers don't want ships. They want their money back, as much of it as possible. And they only will take the ship because they feel that they can sell it to someone else who will help them get their money back.
Yeah, absolutely. Okay, so I wanted to shift to the other part of what we brought up at the intro, which is that you do have a global outlook. And I'm just curious, we have an audience around the world, but we focus on the U.S. markets, and I know that's where, even though I live in Europe, most of my time and attention goes to the U.S. market. Curious how you're seeing other markets and other countries holding up in this period. Are we seeing the U.S. correct me if I'm wrong, has been a leading market for the past decade? If, let's just use the past decade. Is that still playing out in this recession or in this downturn, or how are you seeing things? And how are you seeing opportunities show up?
Well, it depends what you mean by leading market, in the sense that its prices have just gone up more than the stock prices in a lot of other markets, or if you also mean it's the market that a lot of people pay attention to, which in part is related to its good performance over the past decade. I do have to say that the past few months have again reminded us how different Wall Street and Main Street are. How they're living in almost two completely different worlds. I mean, all across Twitter, we've been exchanging messages saying, if I told you a year ago that the Fed was going to be cutting rates to zero, that, businesses and schools were going to be locked down, that, businesses were, not going to be running, you were going to see record bankruptcies, record unemployment, like 3 million a week, people losing their jobs, and the markets would be flat. Most people would think that that's absolutely nuts. No way. And if you look over here, we've seen huge variation in how markets have performed out here in Asia. So year to date, the Chinese markets are down only about 5%. I mean, they were the first to sell off, but they've recovered fairly quickly. They're off even more than the NASDAQ. And, and arguably the Chinese market is actually more robust and more back on its feet than the US market. I mean, people I'm speaking to in Shanghai and Shenzhen are saying things are mostly back to normal. Yeah, we still got some masks, still some people taking temperatures. The kids are wearing these funny hats in school, but at least they're going to school. They're definitely, I think, been on the track back to normal in ways that they haven't. That's up in mainland China. So fairly similar things in Taiwan and Korea, where again, they've got fairly strict controls, but it seems again under control. Like here in Hong Kong, we've had less than a handful of cases in the whole past week. We've had a total of 4 deaths since the whole thing began. And my father in Florida keeps asking me, well, how is it that we've got 100 times more deaths, in Florida than they've got in Thailand or in all these places that we thought were third world countries? And I said, well, you've been to Asia recently. You know how we are about social distancing. You know how paranoid people are about diseases. You know how we're used to wearing masks and how we remember SARS and things like that. There are certain differences where I feel Asian countries have definitely handled this from an actual human health crisis point of view much better than the US. But on the other hand, I was talking about Chinese markets. Indonesian markets have done horribly. Indonesian markets, the MSCI Indonesia is down like 35% or so this year. Korea is down 15% this year, and they've done more tests than anybody. Mm-hmm. Now, part of that, of course, is not just you matching a country with an ETF. You have to actually look at what's inside. The reason the Korean index is down is because it's mostly manufacturing. And no matter how well things are working in Korea, if Korea is exporting fewer manufactured goods because the global economy is weaker, well, that's going to hurt Korea more than it's going to hurt, say, domestic e-commerce companies in China. So that's where it really matters, looking down at a sector by sector level, as well as a country by country level.
So you're saying we shouldn't be starting a price to tests ratio as a way to measure the different countries in their performance.
I've actually been thinking about that, but it's unfortunately a lot weaker than I like. Because yeah, if you did a percentage of population tested versus versus performance, you would think that those that have done more testing are the countries that have their act together more.
Right.
Now that said, I think what it's also shown is that I think if you look on a spectrum, you're in Europe, I'm in Asia, and we're probably speaking mostly to a U.S. audience. The U.S. is probably actually in the middle of the road in terms of how different regions have handled it. I think Europe was probably the region that was most caught off guard and probably hit the hardest, even harder than the U.S. in many ways. Whereas, Asia's done, I think in many ways more or less well. It's all about, I think what standards you're comparing it to.
Yeah, and I think, not to diverge too much, but it strikes me that every country, at least Western country that's used to not used to placing such controls, they all needed to experience a little bit of pain before they acted, which unfortunately was probably too much because then things spread before they really get control. And so that's just a commonality. Whereas, as you said, with SARS and with other virus
SARS and
cases,
MERS and
yeah,
swine flu. I mean, it's like funny here. We've gotten used to having them almost every 5 years, 5 to 7 years. Whereas, yeah, you're in the U.S. A part of even the reason why I wasn't worried about the U.S. early on is because I said, well, we had SARS, we had MERS, we had swine flu. None of those really reached the U.S. in any big proportion. We've got the seasonal flu. So I think a lot of it is about putting it into perspective and, you know, knowing what you're used to and knowing what you're not used to.
absolutely. So you, I know you made the point when we emailed about this that this is a overly broad question, and I acknowledge that. But I'm curious, as a dividend investor, you want to watch out for cuts. You want to watch out for, again, sustainability, as we talked about earlier.
Yes.
Do you
Sustainable
see
dividend. Yeah.
do you see any distinction? Is there any, when you look at the U.S. markets versus looking at some of these other markets, Korea, China, Indonesia, even, are you seeing any differences on a general level in terms of companies are on more solid footing, or companies are in the U.S. have taken on more debt, or do you see any sort of, is the U.S. an outlier as compared to these other countries, or how do you see markets shaping up in terms of the possibility of dividend cuts and of cut downs in income for investors ultimately?
Well, I think the US is a bit of an outlier in the very short term just because of the scale of the Fed response and the two different markets that you effectively have with kind of technology on one end and industrials on the other end. You're really seeing that divergence. And we see some of that divergence out here as well. But the Fed response, I mean, you talk about the US being a leading market. The Fed response really started there and kind of affects here as a secondary effect. The main factor I've really looked at across the board, and we mentioned this earlier with cruise lines and with MLPs, is leverage. So to give one example, the dividend cut here that seemed to catch everybody by surprise, and one of my recent Seeking Alpha articles were, this dividend cut should have surprised no one, was HSBC. Well, the reason it surprised people here is HSBC is the bank. It is the bluest of blue chips in Hong Kong. It is still a top Hang Seng Index component, even though they moved their headquarters to the UK, like 25 years ago, before Hong Kong was handed back to China. But that said, people are like, oh, it's the bluest of blue chips. It's maybe slightly more risky to buy HSBC stock than have an HSBC time deposit, but that 5% dividend is safe, until it wasn't. Now, the reason that I said it should have surprised no one is you have to look at how a bank works. I mean, the whole way that a bank works is that, it takes a dollar of capital, goes and borrows $19 from bond markets and depositors, and then goes and invests that in $20 worth of assets. Well, you know what? If there's a 5% loss in those assets, those $20 of assets are only worth 19, well, the equity holder's wiped out, and they're going to be the first one to not get their dividend. And that's how banks are run. That's how financials are run. And in a way, you can extend that line over to just about every leveraged company. So if you look at all the way at the other extreme, you look at companies that have very little debt, very little leverage. Okay, if revenues are down 10%, okay, yeah, it's going to hurt. The company even has some discretion to decide, do we want to cut our dividend or not? And if we do, maybe we cut it 10% or not. And part of that's just based on, do they want to be in dividend aristocrat indices or kind of meet some of these other blind screens? When I look at a company like China Mobile has very, very little debt. They have more mobile phone subscribers than any other mobile phone carrier in the world. They're a very, very, very boring business. Now, and that's a two-edged sword. On one hand, the Chinese government owns 3/4 of them. And as a result, they're going to make sure that they benefit their customers at the expense of shareholders. That's the biggest complaint many investors have about investing in China Mobile, is that it's not run for shareholders. It's run for the government and ultimately for the Chinese people to have cheap mobile phone service. But that said, as long as they keep paying their bills, that's got a pretty safe dividend. You don't have that 5% move in balance sheet problem that can completely wipe out your dividend. So that's an example of a relatively safe, boring company that has I would say, a relatively safe, sustainable dividend because it doesn't have a lot of debt. Now, again, the story I wrote about in my piece on China Mobile is 5G and 6G will have a lot to say really about the long to medium term future of China Mobile. We don't know how those are going to play out. 25 years ago, the company barely exists because we weren't using mobile phones yet. So that's, again, why time horizon matters.
Just quickly, since you mentioned that, is that more from the risk perspective, as it could disrupt their business is providing cheap mobile access, but maybe new forms that come in place, or is it more opportunity because it brings more people on board and opens up more business opportunities for them?
Well, it really depends on how they manage it. That's the plus and minus of being kind of one of 3 state-owned legacy carriers. I mean, so the older one was China Telecom, and they're still there. China Unicom and China Mobile. That is the triopoly in the Chinese mobile phone market. If you are going to go get cell phone service in China, it's one of those 3. Those are your choices. AT&T or Singtel, they have some joint ventures, but none of them are going to go in and compete with China Mobile. Now, okay, the medium-term question is something really going to change where suddenly we no longer need phone service, we no longer need access to these? I find that a very hard future to imagine. It's a far, I would say, harder thing to change than us all changing from BlackBerries to iPhones. Because that was the case with RIM, is at that time it was a really hot stock. We all saw how everyone was going around with their BlackBerries until suddenly everyone switched to an iPhone. Well, handsets are much easier to change than the fundamental way that we all communicate with each other. Another example that I've given recently was airlines versus airports. So I wrote the article on why I'm buying shares in airports. I'm not buying shares in airlines, because it's much easier to let an airline go bust and replace the airline than it is to replace an airport. I mean, airports are there. Usually a city will have one of them, maybe 2 or 3 of them. And my favorite airports are ones that have very little competition from other forms of transport. They're in places that have no high-speed rail connection, relatively crummy roads. And so really, you want to own airports of Thailand. That's the only way to get in and out of Bangkok. You don't really have a lot of other options like you do in, say, Shanghai, which has excellent high-speed rail and maritime connections.
Yeah, that's I actually own a few airports as well, and so that resonates with me. So you've talked a few names, but any other names you've mentioned on both the distress side and on the more sustainable global business side? Any other names that stand out to you at this point?
So sorry, Daniel, you were breaking up a little bit there, but I think you were asking me for any more names that stand out to me that I'd like to say a little bit about. And these were, I guess, touching on 2 words that we've mentioned earlier. One is distressed, and then the other one is sustainable or great business. So on the distressed side, you might call this a little bit of a cop-out, but I'm going to name one of my favorite companies, which is not really distressed, but it trades like it is. And that is Hang Lung Group, which I've written an article about in my market for my marketplace audience. They are the owner of some prime properties in downtown Hong Kong, in Shanghai, right on Nanjing Road. And some of these are commercial properties, but even in terms of office properties, this includes the Standard Chartered building, right in the heart of Hong Kong's financial center. It includes Cornhill Plaza, which is a mixed-use residential commercial compound, in the Peak Galleria. If you've ever been to the Peak in in Hong Kong, Victoria Peak looking down, they own that as well. So it is a prime of real estate, and it trades at less than 35% of book value. Now, why is that? The part of it is a complex group structure, which make it so that not a lot of analysts follow it. It is a majority owner of a subsidiary called Hang Lung Properties, and Hang Lung Properties is in the Hang Seng Index, but Hang Lung Group is not. As a result of that, Hang Lung Properties trades at a significantly lower discount to book value than Hang Lung Group does. Now, one of the things about Asian companies is that they have these stacked group structures in a way so that every part of the group can maintain 51% ownership and always have a minority float out to minority shareholders like us. You know, it lets them raise more and more capital without ever giving up control. And as a result, they've never really had to raise that much debt. So it's not distressed in the sense that it has a lot of debt relative to its cash flows or assets. It does have a fair amount of debt, but at very low cost and low relative to its cash flows or assets. But it's overall a phenomenally well-financed company. And unless you believe that those buildings, you know, in Shanghai, in downtown Hong Kong, on the Peak, in Cornhill Plaza, are, let's say, going to lose 50+% of their cash flows, are going to lose 50+% of their values, it's got quite a bit of upside and definitely trades like a distressed name. Now, on the sustainable or good companies, I want to name one of my favorite companies that may not be sustainable from a green ESG point of view, but it's definitely one that I do not think is going away, and that is Diageo. Now, I know not everybody listening here drinks, you know, Johnnie Walker or Bailey's or some of these real top world-class Diageo brands. But I can tell you that even if people aren't going out to bars, a lot of people I know are still drinking. You know, they're drinking whiskey, they're drinking, you know, whatever it might be. And, you know, I don't think we're going to see a huge hit to Diageo's overall sales. Again, they're not running the bars. They're just providing all of these branded whiskeys that are going through. And you think of their different channels, there's direct-to-home sales, they're the kinds that people buy to drink at their home, you know, for parties and so on. That's the part that hasn't been hit so much, or arguably is actually having sales go up. The losses are in sales to bars and also sales to duty-free. On my last flight before I got quarantined, you bet I maxed out my duty-free allowance. And I was noticing Changi Airport, you know, doing sales because there really weren't very many volumes coming through those airports at the time. But if you ask me, you know, medium to long term, 20 years from now, will people still be drinking Johnnie Walker whiskey? You know, unless millennials are far more staid and far more teetotal than the millennials I've met so far, I would probably say yes.
Yeah, that's a really interesting, that proportion of direct to home, and arguably in the pandemic people are drinking a little bit more than normal versus bars and that business. That'll be an interesting thing to watch. And Diageo's balance sheet is pretty solid, pretty
Oh, yeah,
comfortable.
it's a solid company. I mean, the thing is, it's a boring company because they take, you know, they take water, they take grain, they ferment it in alcohol, distill it, and they slap a nice expensive label on it and sell it for huge. You know, it's not exactly Coca-Cola, but it's one of those that are kind of in the similar to Coca-Cola category in a way. And it's one of those that you never seem to really find at a cheap or attractive price. So we tried to get a little bit greedy and we picked some up. And I unfortunately have to put some in quotes because it wasn't as much as I wished, with the dividend yield popped over 3%. And I guess it is a sign of quality that it didn't stay there for very long. I mean, it was one of those many names that popped right back up because I think anyone who wasn't just panic selling realized it's one of those quality names and not one of the ones that should be staying in the category of the distressed names.
Well, and I think that's such an interesting tension for investors. You know, we've sort of hit on that. The last conversation I had was in similar, that do you gravitate towards the distressed plays, or do you gravitate towards quality? Because even if you're paying up, you know that it's going to be there in 5 years, 10 years. And so let's just think about, you know, if we're looking to get money into this market right now, those are going to be on relative sale as compared to, you know, 6 months ago. So why not go to there? And so that's, I
Well, that's
think,
what was keeping me. That was what was keeping me up all night in March. Was trying to find the babies getting thrown out with the bathwater, the, you know, highest quality that I could buy at, you know, at reasonable discounts. And they weren't the 80% off discounts, but some of them were even like 30% off or so on. You know, it's like if you like sales, you know, we're running into sales like that. You don't always want to buy the thing that's 90% off. You know, sometimes the higher quality thing that's 30% off is great. And as we saw, sometimes that won't last very long. And that's what I don't like, because I don't like to rush. I don't like to be time pressured. I would rather take my time and look at it. And I had to stay up a lot of late nights in March because I felt that that time was really, really getting compressed. But, as somebody said one time, it's like, well, what is the VIX? A VIX is a measure of how quickly time is passing. So if you think of it that way, that certainly explains the level of stress many of us felt who like to look into companies there.
Absolutely. And that's, I mean, I know you've had experience in different cycles. And so for me, this was, I started investing at the beginning of the decade of the 2010s. So I saw, 2018, and there were a few other flash crashes, but this was really felt like the first big crunch. And it definitely, the emotional management as well as the time management when you get into that. I mean, I did more buying in the first week or two of March than I did in the middle when we were really at bottom, and so that's again that experience and being able to go through it another time is really invaluable to investors as long as they maintain as they haven't made any big mistakes that cost them their capital for the future.
Well, and I think it also reminded us the importance of having a plan and methodology as well. I mean, there were certainly some names, some ETFs, closed-end funds, and so on, which I just always have limit orders sitting out there at like 5-10% below market. And that one of the reasons there was that whole hoopla about the fixed income ETFs. And well, the fortunate thing is we had some limit orders that were there, 5% below market, 10, and the thing is some of them got triggered. Some of them got triggered below where the NAV ever went. And, where I was kicking myself were for some of the other names where we didn't have such orders. So if you have a plan and the plan says, what, I will be ready to buy XYZ at 5% below market, at 10% below market, and you put in the limit order and it happens in your sleep, well, that's great. You've taken that emotion, you've taken that later decision making out of the action. You've just made the action automatic. And then again, if you said, I'd be happy buying it at 10% down and it keeps going another 10% down and you don't care because you were happy with that price you got it at, most of those we're happy with them already now. So, and I keep saying, I never pretend to try and pick the bottom, but ultimately what I hope that I'm always prepared with is kind of having that buy list, having those things that I've done the checks on and said, okay, these are good. When they go down, we want to buy more of them. And okay, these are some names where, the quality is maybe shotting off a little bit. I've never considered myself a momentum investor, although sometimes I do look at something called fundamental momentum. And so you think of dividend momentum as in, okay, are dividends rising or falling, or earnings momentum, or revenue momentum, or you can play with that word, you can stretch that word probably a little bit too much. But as a really poor man's indicator, that's a quick thing that I can put on my Seeking Alpha dashboard to say, are dividends earnings rising or falling? And should I look more into this name or that name? And yeah, that's what keeps it exciting.
Absolutely. Okay, well, great. I've been speaking with Tariq Dennison, who is the author of Long Run Income. You can check out his work on Seeking Alpha. You can check out that service on the marketplace. Just type in Long Run Income, no dashes or anything. Tariq, thank you so much for your time today. Any disclosures in any of the stocks that you mentioned?
Yes, Daniel, I was going to make sure you asked me that. So yes, we are long Diageo, we are long Hang Lung Group, we are long China Mobile. We have no position in HSBC. I want to think of did I mention any of their specific names that I need to have a disclosure on?
You mentioned the cruise lines.
Yes, we are long all three cruise lines.
You are long
Royal Caribbean, Norwegian, and Carnival, yes.
Oh, okay. And you mentioned the Thailand airport. That's
yes, and we are long airports of Thailand as well.
Perfect. Okay, great. All right. Well, thank you so much, Tariq.
Thank you, Daniel. Great speaking with you.
Absolutely.